Hey, it's Craig Haskell with the Value Hound Academy, and welcome back to another session. Today we're going to talk about the 4 stages of a market life cycle. What are the life cycles? Did you know they had life cycles? How do you pick a market to invest in? Well, we can agree today is a great time to buy real estate. It's a great time to be a value hound. We understand that, but how do you pick a market? Well, to do that, you need to understand the 4 stages that a market goes through, a market life cycle. Every market goes through that. It could take 10 years, it could take 50 years, it could take 100 years. Every local market is different. But we need to understand these 4 stages so it helps us pick a market and it helps us pick a strategy, because certain strategies work better in certain stages. All right. Now, I've colored these 4 stages with green, yellow, and red. I like green. Green is go. These are areas that I think are great areas to concentrate in. Yellow is a cautious area. It's a great area to make money, but you need to have some certain types of expertise. Yellow is stop. We don't go there. This is trouble. In fact, I owned an apartment building years ago that we tried to evict some bad tenants, and guess what? They burned the building down. So this is a tough area. If you're really skilled, you're very budget conscious, you're very hands-on, you have a thick skin, this is a great area to be. But let's go through each of the 4 stages. The first stage is the growing stage. Let's look at some of the market characteristics. In the growing stage, we find newer construction. There's more land, we have higher unemployment, we have higher average income. This is a very active community. There's a lot of community involvement. People are active. There's lower crime because of that. We have higher ranked schools, higher demand area. Property values and rents are higher, and cap rates are the lowest. This is the lowest risk area, so you're going to find probably the lowest cap rates. I like this area right here because this particular area probably has the highest intrinsic value of all of them. When you're out looking at marketplaces and you see this area a little bit higher price than some of the other ones, don't be scared off because it has higher intrinsic value. You're going to get paid for it down the road. So I like this one. Let's look at the declining market. Now, the declining stage here used to be a growing stage, but because it's starting to get older and it's starting to transition, it starts to decline, and we start to see less construction, more mature landscaping, older properties, weaker demographics. Some of the common areas are a little bit more run down. You're going to find a little bit higher crime. You're right next to the growing area because, again, it used to be a growing area. Lower property values and lower rents. This particular stage is an opportunity to make some money, but not right now. As the market starts to get a little bit stronger and we start to build more space, more units, the construction stage starts to kick in other words. This is a good place to be, but not right now. This is where the low-hanging fruit is right now. So let's look at the stagnant stage. We actually transition from declining to stagnant, where there's really not much going on. This is a scary stage to be in because there's almost little to no growth going on. Many of the mom and pop businesses, you're not going to find some of the national chains that want to set up shop in this particular area. So you're going to see a lot of mom and pop businesses. Probably has the lowest demographics. It has the highest poverty. A lot of the public and private areas are in disrepair. If you'll drive down some of the streets, you'll see some of the shopping centers, office buildings, even single-family housing. You'll see them in disrepair. They look a little bit shady. You're going to see some vandalism. You're going to see graffiti. It's probably one of the highest crime areas. Lots of drugs and gangs. Lowest property values. Oh, highest evictions. There's lots of delinquency, lots of evictions. You're going to have higher vacancy. You're going to have higher turnover of space or units. So it has the lowest rents and the highest cap rates. This is a tough area. If you know how to operate again in here, this is a great way to generate cash flow. When you go to sell a property, you're not going to get anything for it. But it's a great way to generate cash flow, but I recommend staying away from it. Now, as we start to transition and the public and the private sector start to do nonprofit organizations start to join together, you start to see some redeveloping going on. So we start to transition into the redeveloping market. And you'll see some areas out there where they're more of the older areas. You'll see some of the growing and herbal renewal programs going on. Some of the local governments offer economic programs, and they'll actually enhance you or incentivize you to put money into the property, and they'll give you some money, give you some interest-free loans and so forth. You're going to see strong government support like I just talked about, close to the employment hub, active city life, improving demographics, lots of public transportation for people to move around, crime's getting better, a lot of active nonprofits in the area. In fact, you see a lot of energy in these areas. I really like the energy in here. And you're starting to see rising property values. Now, in the redeveloping area, this is not a good time to be in this area because we're still in the bottom of the real estate cycle, and we start to need to get to the building, and building costs need to go up because really at replacement cost, we're below replacement cost in a lot of areas. And so it doesn't make any sense to put $50,000 into a building and only increase the value by $25,000. Ideally, we want to put $50,000 into a building, increase it up to $150,000. And so as the market starts to improve and values go up, these start to make more sense. So look at these four markets, see where you're at, actually take a map and look in the local marketplace and try to determine where each of those sub-markets are located. What stage are they in? And what stage do you want to invest in? You need to consider that and what strategies you're going to use. So I look forward to giving you more information on this. I think this kind of gives you a big picture. I wrote an article. You can go on the article bin and find an article about this particular process. Any questions, go to the discussion library or this discussion forum and ask any questions. I'll be there to answer them. So I hope this video has served you. Look forward to offering you more information on how to become a value hound and helping you reach for the stars.